Paul from Black Edge Trading. I just wanted to do a video and talk about a few things. Talk about the two banks that failed. Talk about the U.S. long-term rating getting downgraded to AA from AAA. But at the beginning, hit that like button, hit that subscribe button. We're trying to grow our page, and please share this content if you find it helpful. We also have courses available on Teachable, where you can learn learn about the stock market. You can learn to trade the stock market. You learn to invest in the stock market. You can get some coaching. You got some bundles. We got a 50% off sale going on. If you type in Black Edge, put it all together in the coupon section. Type in Black Edge. It'll give you 50% off of any course, any coaching, any bundle. So check us out there. It also comes with the Discord when you purchase one of these, one of the courses, where we trade in this every day. We talk investments. We talk about trading. We share our charts, and you can trade alongside of us. We post a pre-market every morning, so you can see what's going on in there, see what's going on with the market, any news that came out. Also, check us out on YouTube. We're trying to grow our page where I can start tagging this stuff to the page. We got to get past a certain number of subscribers, so check us out. Like this video, subscribe for future content. We'll try to keep you up to date on market and what's going on. But yeah, let's get back to this. So, two banks have failed recently. The government has kept it on the hush because they don't want people to panic again and start making a run on the banks, and it'll make it even worse for them because they'll have to try to bail them out or just let them collapse, which could collapse the economy. So Heartland Bank of Kansas City failed and was shut down by the government, and Pacific Western and Bank of California were ended up having to merge because of concerns on their loan sheets. So, government made them merge. What's going on with the banks? So, lower demand for loans because of higher interest rates. A lot of people can't make payments on a 5.5% interest on whatever they're borrowing. So, they're not borrowing money right now. And banks thrive off of you borrowing their money because they can charge you interest. And also, banks are questioning the prior loans that they put out, and they're increasing their loan standards. So it's much harder to get a loan. They're questioning prior loans that have adjustable rates that may not be able to be paid back by a lot of commercial real estate companies. So that's definitely something you want to watch, because a lot of these commercial real estate developments and stuff could go underwater and could be up for sale pretty soon. So I will watch that. Let's move on to Fitch downgrades U.S. long-term rating from AAA to AA. What does that impact? What is that? What is that? So Fitch is a credit rating, and U.S. credit has always been, for the majority of the time, a AAA rated, which is the highest rating, and meaning by it's almost guaranteed. So it's almost guaranteed they're going to pay their debt. Now it's been downgraded. Has this ever happened before? So it happened in 2011 when I think Moody's downgraded it in 2011. So why did they do this? So first they said the fighting amongst the two parties to try to get the debt ceiling raised, which happened back in late May, early June. That happened, and they didn't like that. And then they said the deterioration of governance, which means they don't think the government is taking serious, the actual balance sheet, because they keep raising the debt ceiling instead of actually fitting within that budget. And we keep getting in more and more of a deficit. Also, rising general government deficit. So the deficit is expected to increase to 6.3% of the gross domestic product, the GDP, in 2023, up from 3.7%. So almost double from what it was in 2022. This rise in debt could have a negative effect on the country's financial health. So those are concerns. Fiscal Responsibility Act and the Fiscal Outlook. Fitch mentions that cuts on non-defensive discretionary spending, as agreed in the Fiscal Responsibility Act, will offer only a modest improvement to medium-term fiscal outlook. This suggests that further fiscal measures may be needed to address the deficit issues effectively. Also, there are other economic concerns. Fitch raises concerns about the economic potential trajectory, warning that a combination of tightening credit conditions, weakening business investments, and slowdown in consumption could lead to mild recession in the fourth quarter of 2023 and the first quarter of the following year, which is 2024. The White House disagrees with Fitch's downgrade, with the press secretary stating that it's not an accurate reflection of the strong economy recovered under President Biden's leadership. Okay. And we all know that's some BS, but we're not going to talk political. We're not going to go there. We're just going to stick to the facts and why it affects the market. So, let's see. I think that's about it. That's everything they said in the article. Also, how does this affect our market? So, increased risk perception. So, a lot of other countries invest in the United States, and they see it as like the standard for, standard place to invest their money, safe place to invest their money, accurate reporting, and stuff like that. But if our own rating agencies are downgrading our debt that other countries will be buying to invest in our future, then what does that say? It makes us look more risky. It makes the market volatile. It has an impact on interest rates. A credit downgrade may prompt investors to demand higher yields on U.S. government bonds to compensate for the perceived increase in risk. Okay? As bond yield rises, it could lead to higher borrowing costs for the government, businesses, and consumers, affecting the borrowing and spending decisions. Okay? So basically, the U.S. government may have to pay a higher interest rate on their bonds because they're deemed more risky. That means they have to print more money. I thought, that's inflation right there. I thought we were trying to get out of inflation. It's a slippery slope. What else? A currency impact. This is how we could be affected. The U.S. dollar value could be affected by a downgrade. If investors lose confidence in the U.S. economy, they may sell off the U.S. dollars, leading to a depreciation in the currency value, which means when we go to buy things from like China and other countries, we could end up paying more because it costs more dollars now because our dollar is not as valuable as it was. What else could be affected? Potential sectors of the stock market, like companies that depend on government contracts. What if the government has to cut back on these contracts because, hey, they can't afford it? What happens to those companies? They get affected. So this is definitely something we want to keep an eye on. We want to watch this story. And then let's take a look at the overall market. Let's take a look at this market and see what the S&P 500 is talking about. We've been in this uptrend. We got a sell signal now. Will we pull back to this trend line? Or where will we pull back to? Let's look at some of the market leaders. Let's look at Nvda. And his little cousin Amd. Let's look at this because this has been driving the market this year. So Nvda over the past 10 years has a 61.86% return rate. Okay, it's pretty good. I mean, that's outstanding. But this year, Nvda has gone crazy. It's returned 242% in 1 year. That's 4 times what it should have returned. What's changed with the company? How's it doing this in these high interest rates? Speculation. I call it speculation. People speculating that artificial intelligence is going to make them a lot more money. Yeah, it could. But I think it's already priced in. So if you're still buying up here, it's priced in already. For the next 4 years, it's priced in. So definitely want to take a look at that. So 61.73%. It's about $89, $90 that it should return this year. It's returned $340. So definitely want to look at that. Valuations are way over what they should be. We're probably going to pull back down into this 316 level. So I would be careful. I would not be buying up here. Interest rates are rising and probably will continue to rise because it looks like the U.S. needs it. They need rates to rise so people can stop buying stuff and they can get this balance sheet under control. Let's see. AMD returns over the past 10 years 38.67% on average. Okay, what did we return this year? Wow, we returned 113% this year since January. Okay, so what does that 38% look like? We should be up around $23, $24 from where we were in January. Okay. So that would put us somewhere around here. $86, $87. I think a safe pullback would probably be to 101, 100, this level right here. So I definitely will watch this sell off. I mean, it's already in effect, but definitely want to watch that because institutions are definitely taking profits right now with more risk being put on. I mean, look at this selling volume candle compared to these other candles. There's a lot of selling going on right here. So I would definitely watch that. And don't be naive. Learn about this stuff. Learn how to invest in the market, why to invest in the market. Learn how to do your own analysis on these companies. Stop listening to people on Instagram and stuff that just randomly talk about the same stuff over and over again. Like everybody knows about Apple and Google and all these companies because they're the only companies that really drive the market. But sometimes those companies get overbought and we need to take a breather from them and let them reset. And this is a time when that happens. So anyway, hope this video was helpful. And thank you guys for your time. Don't forget to like and subscribe and maybe share this. Maybe this will help somebody and they won't buy it, $130 and then, in a couple weeks it's down at 100. They're down $30 per share. And they have to wait another year or two before they can get back to $130. But anyway, just continue to check our videos out and check us out. And we'll be posting more content in the future. Try to keep you updated with the market and explain what's going on. All right, you guys have a good day.